In a first since 2018, the US Federal Reserve raised interest rates by 25 basis points to a target range of 0.25 to 0.5% on Wednesday. The Fed signaled hikes at all 6 remaining meetings this year, launching a campaign to tackle the fastest inflation in 4 decades. This comes even as risks to economic growth mount. The Fed also said it would begin allowing its $8.9 trillion balance sheet to shrink at a coming meeting without elaborating further. Stock markets, on their part, rallied globally as the rate hike was on expected lines. Besides, Fed Chair Jerome Powell's confidence that the American economy was strong and well positioned to handle tighter monetary policy boosted investor sentiment. The S&P BSE Sensex zoomed 1,047 points to end at 57,864 levels, while the Nifty 50 shut shop at 17,287, climbing 312 points. Both the indices advanced 2% each, led by realty, financial, and metal stocks. However, analysts believe the US Fed's hawkish stance doesn't imply the RBI will hike rate in its April meeting as growth concerns linger.
At present, we see upside risk to the domestic inflation scenario and downside risk to the growth outlook relative to the last set of forecasts that the MPC had released in February 2022. That policy review did not telegraph an impending change in April 2022. Given the uncertainty stemming from the impact of the lingering conflict and the geopolitical tensions, we do expect another status quo policy in April 2022, in spite of the rise in the February 2022 CPI inflation and a rather hawkish commentary and dot plot coming in from the US Federal Reserve. While the MPC is likely to be averse to sacrificing domestic growth on account of inflation that is imported, we do believe that anchoring of inflationary expectations may warrant a less dovish tone of the upcoming policy review document. Subsequently, we expect a shallow rate hike cycle with 2 repo hikes in FY23, likely in the August and October policy reviews.
Mark Matthews of Julius Baer too believes the Federal Reserve's 25 basis points rate increase does put pressure on the other central banks, including RBI. However, RBI has the reverse repo rate at its disposal, so it doesn't need to raise the benchmark rate immediately.
On one hand, there is clearly a move toward tightening in central banks globally because COVID is becoming endemic globally, and therefore we can take away the very easy monetary conditions. We shouldn't allow them to remain in place, and also because we have some very high inflation. On the other hand, the RBI has voiced concerns about growth, so we know they are worried about that, and they have shown that they'd be more interested in using reverse repo rates to take away liquidity than the prime rate. So I suspect that April will be a miss and they won't actually raise the prime rate until June. But I wouldn't, as I say, put huge odds on that. And I'd say it's 50-50.
As regards equity markets, analysts believe global markets, including India, are hoping rising rates and de-escalation in the war will tame inflation. This, they say, will improve the market sentiment, but only in the second half of 2022.
I think it's going to be a challenging year. We have inflation, we have rising rates, we have a war, and the benchmark for world indices, which is the S&P, is down 9%. So I think it's going to be choppy with a downside bias until we get more clarity on those 3 big issues that I just mentioned. And I think we can get clarity on those. It's not impossible, but it'll take time, and I don't expect it to happen until the summer.
150 basis point, quite a bit of that basically is already discounted in the market. I think this really rally which you are seeing right now is coming because I think they are seeing some visibility as far as to the end of war. So that is one thing basically they are seeing. So once that goes through basically, then automatically commodity prices will come off. And somewhere the market is hoping basically saying that the inflation will ease off once commodity eases off and world becomes fully operational. So because this is largely supply side inflation, it is not demand side inflation. So somewhere I think the market is expecting which may not see this kind of high, and that's why I think market is reacting positively to this news also.
Overall, the near-term outlook remains volatile for the equity markets as the geopolitical situation remains fluid. Over the medium term, the markets will eye macroeconomic developments and rate hikes by the RBI likely in the later half of calendar year 2022. Domestic markets are closed today on account of Holi.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.